Tip number 5 to avoid a future volpocalypse event is to use strategic long volatility as well during a crisis. Given that stock market valuations are at the second highest level in history right now, if the market did crash in the next couple years, I don't think anybody should be overly surprised. If we look at my tactical volatility strategy, we're in short volatility about 60% of trading days when everything is calm. When risk is rising, we move to the safety position of gold, which is another 1/3 of trading days. And that leaves about 3% of trading days where my strategy is actually long volatility. In every single major market crash, volatility does get extremely elevated. We can see that here with my volatility barometer, where every market crash pushes it to the highest percentiles. Elevated volatility is a clear sign to get out of the market. And secondly, of course, instead of just sidestepping the crisis and avoiding drawdowns, you can actually profit from them. My tactical volatility strategy launched live in January 2012, but it's 100% systematic, which means I can actually drag it back and show what would have happened during the 2008 financial crisis. This is the S&P 500 performance, obviously a very rough period for the stock market, being down 37%. But this is the performance of the long volatility positions from the start to end of those signals, up 126%. Now, simply avoiding the crisis is step one, of course, and it saves an excruciating drawdown. But actually profiting from it is the game changer. Now, my volatility barometer is the best measure to use for filtering those signals, but just as a proof of concept, I can show you that it also works pretty well with even the simplest of filters. If we use the front 2 months of the VIX futures and we just filter for the lowest 3% of all readings, and then we go long volatility just on those days, this is what that performance would look like. So it's not nearly as good as using my volatility barometer, of course, but even just the VIX futures do a decent job filtering and would have made 164% return on just 3% of trading days. Now adding in what the S&P 500 would have done on those exact same days, it would have suffered a loss of -8% with a big drawdown. If you want to avoid the next crisis and even profit from it, you also have to embrace the long volatility side of the equation.